There's a lot of debate of whether a 60-40 portfolio is still suitable for one entering into retirement. And this chart right here makes it seem like the question is quite simple, and that is you should be investing in all stocks all the time. But the truth is it's always going to be on a case-by-case basis. But today, what I specifically want to do is dispel some of the rumors around 60-40 portfolios just by way of explaining who a 60-40 might be good for, who it might not be good for. I'll talk about how you can understand a stock and a bond to help you decide whether a 60-40 portfolio is for you, and a couple of other important facets to understanding investing in retirement. Before that, if you wouldn't mind subscribing and liking this video, it helps me out a lot. And as always, I appreciate your viewership. But let's get right into the conversation. I want to start off by simply breaking down the difference between a stock and a bond, because understanding this clearly is going to help you further understand if a 60-40 portfolio is for you in retirement. Now, I know you probably already know that a bond is viewed as much more safe than a stock. The reason is with a bond, you are a loaner to the company, right? You loan them money, and in exchange for their money, they pay you interest payments, and at the end of the period, you're going to get all of your money back. When we talk about a stock, this is actual ownership in a company. So if you own the S&P 500, you are technically speaking a very small owner in 500 of the greatest companies in America. Now, when we juxtapose those two together, a bond has a limited ceiling, right? You really can only make so much when we talk about owning or loaning to a company. When we talk about ownership in a company, that's when you see the unlimited upside. But at the same time, your investment can technically go to zero. Now, I will say with diversification, as in investing in an index fund that tracks the S&P 500, if your investment goes to zero, we're going to have much bigger problems on our hands than your portfolio. But with that said, some of the main benefits of a bond are income generation, being able to preserve your capital, and finally reducing some of the volatility that you otherwise would have if you invested in stocks. On the other side, the benefit of investing in stocks is long-term growth, generally speaking, much greater than bonds, which you'll see here in a moment. The ability to collect dividends and be an owner, that can play substantial when we talk about the long-term future of your ownership. And then finally, it hedges against inflation quite well, a lot better than bonds do, which again, I'll get to that here in a moment. But now that we have a simple understanding of the difference between a stock and a bond, let me kind of break this video down into two different sections. The first is going to be if you're a long-term investor, and the second is going to be if you're someone that's already retired. And I hope it's helpful if you already are retired to watch this first quick section here, because there are going to be a lot of things that are important to understand when we compare the two. So I want to start by quickly going back to that chart that I showed you at the start of the video, and this is going to represent $1 of investment, as you can see, in 1870, and a comparison between the red bar, which represents a 100% equities, 0% bonds, and the 60-40 portfolio that we're talking about today. Now, as you can see, the red line ends up substantially higher than the blue line. And as simple as it could be to just say, hey, red is higher than blue, so automatically we have our answer here. The answer, or the decision that comes from this, is going to be much more complex, which is what the next chart is going to show you here in a moment. But the important thing that I want to talk about here, especially to the long-term investor, maybe someone who has 10 years plus, or even over 7 or 8 years until you actually need this money, is the importance of combating inflation. Now, you have an enemy every single day that you wake up if you don't need your assets right away, and that is inflation. Inflation, simply put, is the increase in goods and services over time. Every single time you go to the grocery store, things get more expensive. Every time you go to the gas pump, that probably too has been more expensive. And what the stock market has done, historically speaking, has done quite well at not only staying up to par with inflation, but also outpacing it. It's the way that the wealthy have, traditionally speaking, separated themselves from the cost of living, right? That's how you retire. You have enough saved that you no longer have to keep working to cover your living expenses. And the struggle, whether it's a 60-40 portfolio or if it's even an 80-20, carrying bonds as a long-term investor may be nice to see fixed payments come in every once in a while, but really what it represents is falling behind inflation. Right now, as I make this video, the generic bond, the US Treasury in America, can probably get you around 4%. And typically inflation is either going to fall slightly below that or at times close to. So really what you're doing is you're staying on par with inflation. And when you mix in taxes, when you mix in cost of living that you personally have, generally speaking, your real rate of return is going to be less than inflation. In fact, in his book, Stocks for the Long Run, legendary investor Jeremy Siegel has stocks averaging about 6 to 7% real return, and bonds averaging about 1 to 2% real return. So this factors in after inflation. So the bottom line here is that if you are far from retirement, or better yet, if you are far from needing your money, growth is probably going to matter a little bit more than the short-term stability that bonds are potentially going to provide to you. Now let me switch gears here, and let's say that you're looking at retirement around the corner, or you're already in retirement. I want to make you feel a little bit better if you are in a 60-40 portfolio, because like I said, it's not as black and white as it may seem from the previous chart. Now, before I show you that, I just want to say the obvious kind of answer here is that your time horizon shrinks when you get into retirement, right? Myself included, we are all going to die someday, and it's a morbid fact of life, but as you get into retirement, your timeline in terms of how long you're going to live shrinks, so you have much less time to recover if your investment portfolio doesn't perform the way you expect it to. And what I want to highlight for you here is 2000 to 2010, which represents the lost decade. It's a time when a 60-40 portfolio actually outperformed owning all stocks or equities in your portfolio. So as you can see here, due to the dot-com bubble, due to the great financial crisis, which took place there at the end of 2008, bonds outperformed during this market. So put even aside returns here for a moment, what this chart and what all charts don't take into account is the emotional factor that plays into retirement as well. I talk about it a lot, but in retirement, I see that my clients that I work with are much more inclined to watch the news, right? There's just not as much time. You don't have as much time for breakfast in the morning. You got to rush off to work. But once you're retired, you have more time to know what's going on. So following the market at times when, and you looked at that chart, both times fell almost 50%. That's going to be very difficult to stomach, and it might be difficult for you to sleep as well. So that factor is always going to be included here when we talk about having a 60-40 portfolio that might have a little bit more stability in retirement. And another factor to consider here is how far your income, your Social Security in retirement is going to go. So let me show you another example here. If we were to compare in a $1 million portfolio of one invested in the S&P 500 and the other invested in a 60-40 portfolio. As you can see, if we assume roughly a 4 to 4.5% yield, which is not too outrageous right now compared to the S&P 500 dividend yield around 1.5%, you're going to walk away with significantly more from your 60-40 portfolio. And I know a lot of you out there might not prefer dividend stocks. You might not prefer investing solely for income, but this is another potential option to have along with Social Security. If you think of what you might have, you and your spouse, you might have $40,000 to $60,000 coming in per year from Social Security. If you throw in a portfolio such as this and you get another 40 to 60, you're looking at making over 6 figures simply from sitting on the couch in retirement, which I don't know about you, but a lot of my clients do like that picture. So I also want to conclude, of course, with younger investors may want to prioritize long-term growth. As you can see from the charts here today, and just from what's expected in the future, it may be better to stick with more stocks than bonds. But again, it's going to depend on a case-by-case basis. Whereas the retiree is going to have a little bit shorter of a timeline, so there's not as much time to recover, right? If you picture yourself in 2000 retiring and you waited 10 years for your portfolio to compare to the 60-40 that I showed you in that second chart, it may have actually been better to go with the 60-40. And unfortunately, I cannot tell you the future. I'm not smart enough to do that. But you want to have a conversation with your financial advisor about this today, or give me a message and I'd be more than happy to help you out. It's important to understand this prior to getting into retirement, or to make sure that if you are in retirement, that you're having your income needs met. And the answer might not always be a 60-40 portfolio. So I'd love to know your thoughts. I would love to know what you're thinking about for retirement. So as always, thank you guys so much for your viewership. I will see you next time, and have a great day.